Give it one more minute and then hit the mic. It gets to 9:30. When it gets to 9:30, just.
Okay. Better. Good morning, everybody. Quick announcement. We all know that on the 15th of May, we have our final exam of corporate finance. Well, a few hours later, there's a lava party to welcome the summer. I think there's going to be a good atmosphere. Finals are over for almost everyone here. So if you look around, you probably have lava members near you, or maybe not. Maybe it was a tough weekend. But they have tickets. There's going to be a band, and we expect it to be big. So hopefully we'll find you there. And if you're planning to book your ticket, please do it after the 15th of May. Thank you.
It says Grizzly Long Cut Tobacco, Premium Mint. Is it chewable tobacco? Interesting. Maybe they're trying to get me addicted to something I'm not. Anyway, a quick reminder in case you need it that the quiz is day after tomorrow. First 30 minutes of class, you need to let me know if you're going to miss the quiz. The review session is tomorrow from 12 to 1 in KMAC 260. So it'll be webcast. I know many of you will not be able to make it. But it will cover capital structure, right? So everything through whatever I think we ended at page whatever it was, the end of capital structure. So it'll cover just capital structure. Chapter 7, 8, and 9 in the book. So you got your task laid out in front of you. Let me pick up though on dividend policy. I know it's not in the quiz, but it is on the final. You have to do it on the project. And it's not complicated. And we laid the foundations for it last session. We talked about dividends being the end game, which is what we're doing. When you invest in a company, you want to harvest the company. Dividends are your harvest. And the question is, when do you harvest? How much do you harvest? Okay? So we looked at the facts on dividend policy. They're sticky. They tend to follow earnings. They're increasingly being displaced by stock buybacks at companies. And they vary across countries. And they're affected by tax laws. So today I want to start on the discussion of how to decide what the right dividend policy for your company is. I mean, that's the practical question. So we'll start with the simplest template I have for looking at dividend policy. And this is a template I've used on the other aspects of corporate finance as well. You tell me where you are in your life cycle as a company. I'll tell you what the right type of dividend policy it is. It sounds more complicated than it really is. But let's go through the life cycle. If you're a young startup and I ask you how much can you afford to pay in dividends, the answer is no. What dividends? I'm not making money. I'm not getting revenues. I'm not. Even as you keep growing, even if you start making money, if I ask you how much can you pay in dividends, your answer is still going to be no, because even though you're making money, because you're growing so fast, everything you're making is going back into the business. You cannot afford to pay dividends. So when I say you cannot afford to pay dividends, also add buybacks at the end. You can't do buybacks either. Then you keep growing. Your revenues keep growing, but your margins start to improve. You're starting to mature as a growth company. You're not a mature company, but your margins are starting to kick up. As your growth starts to decrease, your reinvestment goes down, your profits go up, you start to get excess cash. And as with everything else in corporate finance, when that first starts to happen, you fight it because you don't want to grow up. You don't want to become a mature company. That's why growth companies initially in those first few years after they come out of the high growth, their cash balances will tend to get bigger and bigger. And you see this with a lot of technology companies. Right? At some point in time, reality hits you, which is we're no longer a growth company. We can't keep waiting another year because nothing's coming down the pike. We have $80 billion in cash accumulated. Your capacity to pay dividends comes first. Your willingness to pay dividends comes later. Sometimes it comes on your own. You decide that you have to pay dividends like Microsoft did. Sometimes you're pushed to pay dividends by somebody who looks at you and says, hey, what are you guys going to do with all that cash? But then you start paying dividends or buying back stock, depending on what kind of stockholders. And then you get to the end game. The end game being you're no longer just a mature company, you're starting to decline as a company. Your revenues are starting to decrease, your earnings are starting to go down, but you get a little bonus. Because you're declining as a business, you're not even thinking about putting money back into the business, you're thinking about taking money out of the business. You're liquidating portion of the business, you're becoming a smaller company. It's all about dividend policy. In fact, if you think about the focus in corporate finance, it starts off being all about investment policy. Take the right projects and everything's going to be okay. Then it shifts to capital structure because you're trying to tweak the cost of capital. The last stage in the process, it's all about getting the cash back to your investors in the most efficient way you can. So that's one way to think about dividend policy for your company. You know what I mean by your company, right? The company you're doing on your project. I know you're starting to work on your project. The way I know is each day I get about 5 people saying they're going to change companies, which means you finally took a look at the numbers. They shocked you so much that, oh my God, what did I pick? Hey, that's okay. That's healthy. You're at least getting started. And I'm also getting people getting stuck at various stages. My advice is, I know the quiz is on Wednesday. You can't do anything on the project. Right after that's done, start catching up if you haven't caught up yet. Okay? So now let's talk about how this plays out, this life cycle argument plays out when you look at what companies pay in dividends. Remember we talked about payout ratios and dividend yields last session and looked at the distribution. What I did was I took all US companies and I broke them down by growth classes, by expected growth rate. From high growth rate expected to be greater than 25%, to really low growth. And then I looked at how much companies in each class paid out as dividends, both in terms of payout ratio and dividend yield. And you can pick whichever statistic you want, but it makes sense. When you look at really low growth companies, they tend to have high dividend payouts and high dividend yields. When you get to high growth companies, you get low dividend payouts and low dividend yields. There are no free lunches. We'd like to have high growth companies that pay high dividends, but the reality is, when you look at the market, you tend to see the two kind of moving together. So when growth decreases, your payout ratios and dividend yields tend to increase. So what I'd like to do is start talking about the trade-off in dividend policy using my companies as lab experiments. So let me lay out what my 5 companies, my 5 public companies paid out in dividends. You're saying, what about Bookscape? You know the problem with observing dividend policy at a private company is? You don't actually see what's taken out of the company, right? So if the owner decides to take $50,000 out of the till to build an extension in his house, you don't see it. And you also don't see the line between salary and dividends because the owner might not pay himself or herself a salary. You don't even know what's being taken out is actually a dividend. So I'm going to focus on my 5 companies, and I've reported for each company the dividend yield using the last 12 months leading into whenever I did this analysis. And I want to bring this up in relation to your project. Some of you are working with companies, most of you are working with companies with calendar year ends, right, which is December 31st, your fiscal year and your calendar year match up, which is very convenient for this particular class because by April you've got the most recent 10K in front of you, most recent annual report. You can, in a sense, update the numbers reflected. Yesterday I got an email from somebody who's working with a company that has a February year end. In fact, it is your worst possible scenario if you're thinking about getting a full year's data because there is almost no chance that this will be available to you by May 12th of 2015. You can't put off everything till May 11th anyway. So for companies like those where your fiscal year end is different from a calendar year end, you can go with the last fiscal year, but that's going to be really old data, right? It's going to be 8 months, 9 months, 11 months old. Or you can create what's called a trailing 12 month, which is to take the last 12 months. I've used the trailing 12 month for my analysis because it is the most recent data I have on these companies, and those are the dividend yields and payout ratios for my 5 companies. If you look at dividend at Disney, 1.09% dividend yield, 21.58% payout ratio. The question we're asking with Disney is that the right dividend payout for Disney? For Vale, the dividend yield is huge, 6.56%, and the payout ratio is more than 100%. In fact, let me pause there. What do you think explains Vale's? That looks like a strange, a dysfunctional dividend policy if you look at it, right? Really high dividend yield, you're paying out more than your earnings and dividends, but what might explain it with Vale? That they have a payout ratio that exceeds 100%? They're a mining company where commodity prices go up and down, iron ore prices are down. They're hoping and praying they bounce back. And that's, I think, a big question we're going to have to face if you're Vale, is are they going to bounce back? Because if you look at the history of iron ore prices, somewhere in 2002 you start to see iron ore prices take off. It's almost like they hit a new level. Everything triples. And they stayed high for about 8 years. Much of that iron ore was demanded by China as part of its growth for construction. If Chinese growth decreases, then in a sense the question is, will iron ore prices go back to what they were pre-2003? And if they do, this is going to be a problem. That 113% is not just for this year, it's going to be a problem that they'll have to fix. So we'll come back and deal with that. I've also, just as a comparison, computed the dividend yield and payout ratio over the last 5 years, if you want to think about that as an average across time. On that, it looks a little better, 38% of its earnings. Tata Motors, dividend yield of 1.3%, payout ratio of 16%, very close to what the average is over the last 5 years. Deutsche, dividend yield of 1.96%, payout ratio of 362%. Deutsche had a bad year. Bad year because they had to write off things, bad things happen, and that seems to be the pattern from big money center banks. The question, of course, you face with Deutsche is, if you've taken all the bad stuff off, are you done? And of course, they're going to say, of course, we're done. But the problem we're running into with banks is this seems to be a recurring theme, is every 4 or 5 years you see this huge charge. So that again is questionable, whether in fact they should be doing what they're doing. So already we're opening the door to be able to ask the question of these companies, are these companies doing the right thing when it comes to dividend policy? So I'm going to lay out the big picture. There are 3 schools of thought on dividend policy, and they kind of cover the spectrum. The first school of thought says that if there are no tax disadvantages to investors, remember dividends go to investors, so if investors don't care whether they receive dividends or capital gains, that's a big if. And if companies can go out and raise equity without any transactions cost, so if you want to raise equity in the market, markets are open, they're accessible, and they're essentially costless to access, it does not matter how much you pay in dividends. And think of the logic, and we'll go through the logic a little deeper. If there are no tax differences, you as an investor don't care whether you get your 8% return as 2% dividends and 6% price appreciation, or 5% dividends and 3% price appreciation. Now part of the problem you face as a company is, what if you pay too much in dividends? In this world, if you pay too much in dividends, what do? You issue equity, it costs you nothing, you make up the difference. So in a world with no taxes, or no tax differences between dividends and capital gains, and where capital markets are easy, accessible, and costless, it doesn't matter how much you pay in dividends. Does that sound familiar? When we talked about capital structure, wasn't there something similar that we, remember that? That was Miller-Modigliani 1. Miller-Modigliani 1 says it doesn't matter how much you borrow. Miller-Modigliani 2 says it doesn't matter how much you pay in dividends. If we lived in a Miller-Modigliani world, this class would have been over about 7 sessions ago. Because right after you did capital budgeting, you might as well have shut shop. What else can you do? So if you live in a world with no tax differences and you can raise capital, it doesn't matter how much you pay in dividends. Don't be too quick to dismiss this school, because there might be some companies which actually fit these close enough that you can get away with it. The second school of thought argues that dividends are bad. And this school actually had its foundations in the US through much of the last century. And it's based on the fact that dividends, and we talked a little bit about this last session, that dividends have historically been taxed at a much higher rate than capital gains. And if you bring that into the picture, then the conclusion seems simple. If you're a company, you do not want to pay dividends. You'd much rather give it out as price appreciation, because dividends get taxed at a higher tax rate. So the conclusion here is, If you're paying dividends, stop. Don't increase dividends. Don't even maintain dividends. Make them go to zero, because dividends are bad and they hurt stockholders. So dividends don't matter. Dividends are bad. Might as well round out the spectrum here. There's a third school of thought that says if your stockholders like dividends, why? It's not your problem. Just like the customer's always right in marketing, the investor's always right in dividend policies. If your customers like dividends or your investors like dividends, pay them more in dividends. So this is the dividends are good school. So dividends can have no effect on value, can be bad for value, good. It's incredibly convenient for a CFO to have all three schools of thought. Because no matter what you do as a CFO, you got an entire school of thought backing you up, right? If you cut dividends, you point to the dividends are bad school. If you increase dividends, you point to the dividends are good school. And if you have no idea what you're doing with dividends, you say, I'm in the Miller-Modigliani school. It doesn't really matter anyway. But there is a kernel of truth in all three schools. And one of the things we're going to try to do is bring them all into one analysis. Because you can't have three schools of thought coexisting that says, no matter what you do, you're okay, because that can't be right. So here's the end game that I'm going to go towards with dividend policy. And you tell me whether it makes intuitive sense. If you're a company which has lots of cash coming in from your, like Apple, billions and billions and billions of dollars coming in from your operations, and you do not have very many investment opportunities, which might not be like Apple, but let's say you are. So if you're a company with a lot of cash coming in, you don't have very much in investment opportunities, I think you should return more cash to your stockholders. Whether you do it in dividends or buybacks is up to you. So that's the first divider. In contrast, if you're a company which has relatively little cash coming in, and you have lots of investment opportunities, you have no business returning cash to your stockholders. So in a sense, this is going to frame how we think about dividend policy. It's not the three schools of thought or whether the taxes matter. It's really about how much cash is coming in, what kind of opportunities do you have. Are you the type of company that should be returning a lot of cash or not very much cash to your stockholders? So I'm going to lay the foundations for this by starting with the Miller-Modigliani school, which says dividends don't matter. Okay? So basically the argument here is the value of a business is driven by the investments it takes. Take positive net present value projects. So your value is determined by that, and once you get that value, how much you borrow and how much you pay in dividends don't matter because you've taken taxes out of the equation. And to make this work, though, you have to make it feasible for companies that pay too much in dividends to make themselves whole again. So let's take an example. Let's say you have a company that can pay 100 in dividends. That's what's left over, but decides to pay 300. It has to come up with an extra 200. In the Miller-Modigliani world, it's not a big deal because you go out and raise the capital, you take the projects you normally would have taken. So the essence of the Miller-Modigliani argument is if the investments you're going to take are unaffected by how much you pay in dividends, your value as a business will be unaffected by how much you pay in dividends. You can already see what can go wrong, right? If a company pays too much in dividends but is unable to raise capital, you know what could happen? They might not take projects they should have taken, then dividend policy starts to matter. So there's a subset of companies we could argue that Miller-Modigliani actually applies, that it doesn't matter how much they pay in dividends, because A, they have enough access to the capital markets that they can raise capital at relatively low cost. They're large market cap companies in developed markets, and their investors happen to be a subset of investors who are really indifferent between receiving dividends and capital gains. There's actually a very large subset of U.S. investors who are indifferent between dividends and capital gains. You know who they are? What type of investors? There's a subset of investors who pay no taxes on dividends and no taxes on capital gains. Pension funds. If pension funds are your primary stockholders, they don't care. So if you're a large market cap company in a developed market with a lot of pension fund investors, Miller-Modigliani might actually hold for you. It doesn't matter. So you know what it tells you as a CFO? How much time should you spend thinking about how much to pay in dividends? Make a decision, move on. This shouldn't be taking up 2 months of your time, 3 months of your time. It's not worth it. So think of that as the starting point, because it gives you the framework for thinking about when dividends don't matter and also when dividends do matter. If you're a company with limited access to capital markets, dividends do matter. If you're a company with investors who get taxed at different rates on dividends and capital gains, dividends do matter. So let's think about the trade-off that drive why dividends matter. I told you about the dividends are bad school. To give you some foundations for thinking about it, in this graph, which is almost impossible to read because the columns have got thinner and thinner each time I redo the graph because there are more years to fit in, I've taken tax rates on dividends and capital gains in the US. Okay? I know it's kind of tough to read, but the purple or whatever color, you can't even see it anymore, is the dividend tax rate, and the green is the capital gains tax rate. So if you look past 1920, starting in about 1921, going all the way through 2003, you can see that the tax rate on dividends is much higher than the tax rate on capital gains. In fact, people don't even realize it, but in the 1960s in the US, the highest marginal tax rate was 90%, which effectively meant that if you received $1 in dividends, 90 cents would be paid in taxes, but the capital gain tax rate was 35 or 40%. So the difference between the dividend and capital tax rate was, so if you were in the 1970s, the question we're asking, and in fact, my dividend policy chapter in my corporate finance textbook was titled The Dividend Puzzle. Because in 1980, people looked at it and said, why are companies doing this? Why would we be paying our dividends when people get taxed at 70% on that dividend? And it might not be a puzzle, but it's a huge barrier to overcome if you're trying to explain why companies pay dividends. So the dividends are bad school is based on the fact that the tax rate on dividends is different from the tax rate on capital gains. But to kind of resolve that puzzle, here's what you need to think about. I just already gave you an opening. I said there are some investors who pay no dividends on taxes no taxes on dividends and capital gains, pension funds. There are some investors who actually pay a higher tax on capital gains than they do on dividends. So if you're an older person, it might be that your ordinary income is so low you pay no taxes. You're actually so what I'm trying to say is you don't have a monolithic group of investors, all of whom pay this highest tax rate, because tax rates vary across investors. And here's what makes it even more complex. They vary for the same investor depending on which portion of their investment portfolio you're buying that dividend-paying stock for, whether it's for your investment portfolio, your IRA, or is it for your savings in your regular investment. So you could end up with different tax rates. So one of the questions it would be nice if we could get an answer to is when you take your company, I'm talking about the actual company you're doing on a project, wouldn't it be nice if you could tell me whether investors in your company, or what investors in your company pay as dividends or taxes on dividends and capital gains? In other words, are you the kind of company where most of your investors don't care about dividends versus capital gains when it comes to taxes? Or are you the kind of company where investors pay a higher tax rate on dividends or perhaps a higher tax rate on capital gains? So I'm going to give you a trick, and it's really a trick to try to back out what investors in your company think about taxes. And it revolves around one very specific day every 3 months for most US companies called the ExDividend day. Let me step back. The way dividends work is the board of directors gets together and declares a dividend. So this happens about 6 or 8 weeks before the actual dividend, ex-dividend day. The board of directors, in fact, you read the news story in the Wall Street Journal the next day. Procter & Gamble board decides to raise dividends by 2 cents. That's called the dividend declaration day. Now, will markets react to that? Yeah, it depends on whether that increase was unexpected, expected, or less than expected. So you get a price effect on the dividend declaration. So this happens about 6. So by the time you get to the ex-dividend day, there is no uncertainty. The dividend is known. You know exactly what you're going to get. So for those 6 weeks, what's happening is investors know what the dividend is. Then you get to the ex-dividend day. What is the ex-dividend day? That is the day by which you got to buy the stock to get that dividend, which makes it a very, very interesting day, because if you buy the stock before the ex-dividend day, it's called cum dividend and ex-dividend, you get the dividend. If you buy it after, you don't get the dividend. So this sounds like a free lunch, right? So you're saying, well, let me just buy the stock before the ex-dividend day, collect the dividend, and sell it right after. Markets are not that stupid. So you know what happens at the ex-dividend day? The price adjusts for the fact that you no longer get the dividend. By how much? That's going to allow us. That's what's going to allow us to crack the code about what investors think about dividends and capital gains. So let's play a game. Let's assume you're all investors in a company. Tomorrow is going to be the ex-dividend day. You know exactly what the dividend is. There's no uncertainty about it. The price right now is PB, price before the ex-dividend day. All of you bought these shares 5 years ago. You know why I made it 5 years ago? Because that's what makes it a capital gain. If you bought it yesterday, then you really don't care. So you're all long-term investors in the company. The price right now is PB. Tomorrow is the ex-dividend day. If you sell the stock right now, you're going to collect PB. You're saying, why would I do that? Because if I do that, I'm not going to get the dividend. Okay. If you sell it after the ex-dividend day, you get PA, but you collect the dividend. So basically, you have a choice. Should I sell before or should I sell after the ex-dividend day? If for all of you, the price from selling before was greater than holding the stock through the ex-dividend day, you know what will happen, right? You'd get a wave of selling before the ex-dividend day. And if you get a wave of selling, what's that going to do to the price? It's going to push the price down. What I'm trying to say is for this market to be stable, for most of you, you know what has to be true? The price from selling before, the cash flows from selling before, have to be roughly equal to the cash flows you'd receive if you held on through the ex-dividend day. Algebraically, here's what I'm saying. The price you get if you sell before is PB. You'd have had to pay a capital gains tax on that price and the capital gains tax is based upon what you originally paid, which was P, times the capital gains tax rate. If you sell after, you get PA. You subtract out the capital gains tax, but you'd receive the dividend net off whatever the tax rate on dividends is. Those are your cash flows from before and after. And to keep you indifferent, those two cash flows have to be equal. So I set the two equal. You're saying, where's this going? Trust me on the algebra, but if you work through the algebra on this indifference point, it turns out that for you to be indifferent between selling before and after, the price change on the ex-dividend day as a percentage of the dividend has to be a function of your ordinary and your capital gains tax rates. So let's take the extreme example, or the simplest example. Under what conditions will the price drop be exactly equal to the dividend? What has to be true about the taxes you pay? You have to pay the same taxes. Either you got to be a pension fund where you get zero taxes, or you could be in the post-2003 era in the US and say my tax rate is 15 or 20 or 23.8% on both. I should be indifferent. If, on the other hand, this was 1995 or 1970 or 1960, your ordinary tax rate would have been a high number, 60, 50, 40, 80%. Your capital gains tax rate would have been a lower number. So what would you have expected to observe as the price drop on the ex-dividend day? It should be less than the dividend because you're paying a much higher tax rate on dividends than in capital gains. There are some parts of the world where capital gains tax rates are high or some number, but there's no taxes on dividends. If you were in that part of the world, the price drop on the ex-dividend day should actually be greater than the dividend. See where I'm going to go next? I don't know what your tax rate is. I don't know what your capital gains tax, but I can observe what happens in the ex-dividend day. By observing what happens in the ex-dividend day, I'm going to draw implications about what your tax rates must be. So if the price drop on your stock is roughly equal to the dividend, then I'm going to make the argument that at least in your company, investors are indifferent on a tax basis between receiving dividends and capital gains. If it's less than the dividend, then investors in your company, for whatever reason, must feel that there's a penalty attached to dividends relative to capital gains. If it's greater than zero, it must be that there's a penalty attached to receiving capital gains versus dividends. So that's essentially the insight I'm going to use to decide whether investors in your company like or dislike dividends, what they think about taxes, to look at what happens, not on one ex-dividend day, because that can be dangerous, but across a bunch of ex-dividend days. Right? On any one day, who knows? Market could be down 10%, up 10%, but across ex-dividend days. That's what you should expect. This is actually a statistic that's been tracked over time by a bunch of studies. The very first one was actually done in the early 70s, and it looked at the late 60s. Remember, in the late 60s, the ordinary tax rate was 70%. That's a dividend tax rate. The capital gains tax rate was 28%. What the study found was, on average, the stock price drop on the ex-dividend day was only 78% of the dividend. So if you received $2 in dividends On the ex-dividend day, stock price dropped by $1.56. Okay. Then you move to 81 through 85. The tax differential has narrowed a little bit, and the price as a percent of the dividend has increased to 85%. 86 through 90 was a brief period where you had the same tax rate, so that's very much like the period we're in right now. But here's a puzzle. Even though the tax rates on dividends and capital gains had converged, the price change did not become 100% the dividend. In other words, investors were still acting like there was a disadvantage to receiving dividends relative to capital gains. And I think they were right. In fact, I think it's still right. Even though the tax rate on dividends and capital gains is the same today, I think there is still a disadvantage from a tax perspective in receiving dividends as opposed to getting capital gains. What is that tax disadvantage? Did any of you do your taxes on April 15th? This year would have been really easy, right? No income, no taxes, go away. Though you might have made income before you came back to start. So presumably, okay. How did dividend, yeah? Well, capital gains will too, right, if it's a capital gain. But go further. When do you get taxed on dividends? You don't get a choice. As soon as the company pays the dividend, you have to pay taxes. You can't say, I don't feel like paying taxes. I'm not spending the dividend right now. The company declares a dividend. It shows up as in your 1099. You got to pay taxes. When do you pay taxes on capital gains? Only when you sell. And you get to decide when you sell, right? Sometimes you have no choice. Liquidity might drive you to sell it. There's a timing option with capital gains that you do not get with dividends. See what I mean by the timing option? You get to decide when to pay in taxes. Maybe you will pay taxes in a year in which you have low income or you have capital losses. Or you could just wait till you drop dead. In which case it's not, but you know what happens when you drop dead, right? First you're dead, you get buried, but your portfolio gets passed on, and essentially there's an estate tax you might have to pay, but if you are able to get past this, you get that one-time increase in basis almost, so your successors then have to deal with it. But with that timing option, effectively you're paying a lower tax rate on capital gains than you do on dividends. So even though the tax rates might be the same, I think it's not as big as it was, obviously, in the 80s or the 70s and 60s, but that price change is still a little less than the dividend. And therein lies a potential for profit for some investors. So let's see what that is. Let's assume that this 90% statistic still applies. That dividends, if a dividend is $1, the price drops by just 90% of it. Let's say you're a tax-exempt investor. You don't have to pay dividends and cash. Can you see a way in which you might be able to exploit what happens the ex-dividend day? And I'll give you some choices. Maybe you can invest in the stock in the long term. Is that a good choice? What's the long term got to do with the ex-dividend day? Cross that out. That clearly is not it. You could try to sell short the day before the ex-dividend day, buy on the ex-dividend day. Only if you want to have a really convoluted life. Or you can buy just before the ex-dividend day, hold for one day, and sell at the end of the ex-dividend day. So what happens? You buy before at PB, you sell after at PA. So the price drop is going to hurt you, but you receive a dividend that is higher than the price drop. This is called dividend capture or dividend arbitrage. It happens all the time on large dividend paying stocks, where investors who don't face a tax issue can come in and buy shares. So here's an example of how it would work. Let's say you have a company, and it's usually a big utility or a big phone company, a big dividend-paying company. Stock is selling for $50. Tomorrow is going to be an ex-dividend day, and the dividend is going to be $1. Let's say you believe these studies, and remember that's where one of the risks comes in, that the price drop will be roughly 90% of the dividend. Here's what you do. You buy 1,000,000 shares. Don't buy 1,000 shares. It's really not worth it. If you're buying it in small amounts, you've got to buy a lot. 1,000,000 shares. Cum dividend at 50. You wait a day, and if the studies are right, the stock should drop by 90 cents at 4. So you're going to sell it at 49.10. You're going to receive $1 million in dividends. Your net profit is going to be 100,000 for holding for one day. In fact, when you see this happen on the tape, you don't even often need to hold it for a day. You can actually get this. Now, if you get a chance, watch a big dividend-paying stock, the ticker on the big dividend-paying stock. Unfortunately, many of these trades even happen off the floor now. You don't get to see them. In the old days, you actually used to see trading volume on a Con Ed jump 10 times on the ex-dividend day. So where's all that coming from? It's coming from the dividend capture strategies where people buy in millions and millions of shares, sell it. What's the risk, though? I'm sorry, what? That the shares go down for not because the ex-dividend strategy doesn't work, but there's other stuff happening in the market, right? So if there's a Middle East crisis or a Russia crisis or a Greece crisis that day, it's going to wipe out whatever the studies tell you about the ex-dividend day. So if you're going to do this, you're going to have to do this on a lot of stocks and a lot of days and hope the law of large numbers kind of gets rid of the market effect. Just to give you a cautionary story, this ex-dividend study, these ex-dividend studies have been around a long time. The mid-'80s, the treasurer of an Oregon county decides to take county money and take advantage of this ex-dividend day behavior. So he puts all of his money on one large dividend-paying stock on one ex-dividend day. This is it. I'm going to get famous. I mean, I'm going to increase our returns by 5% this year. Unfortunately, the day he picked was October 19th of 1987. You know what happened on that day to the market? The S&P 500 was down by 23%. If you were to visualize how bad a day that was, think of what that would translate into today in the market. 23% in one day. This was a bear market in one day. It's actually a very healthy way to get out of a bear market. Get it done, move on, right? But it destroyed the Oregon fund. You see why? Because he was sitting there saying, oh, the price drop will be 90% of the dividend. Well, good luck to you. If the market's dropping 23%, it's going to wipe out that 90% and keep going. So if you're going to do this again, do it in large numbers. But you can see what's driving it is differences in tax rates across investors. And what's making this even messier is we're now in a global marketplace with very different tax rates for investors in different countries. So you're seeing this tax arbitrage play out in lots of different ways in lots of different countries, especially around ex-dividend days. So now let's, go ahead. They do pay a dividend. Apple does pay a dividend. Are you talking about an extra dividend?
Right. I mean, they were to bring the money back from outside the U.S., but if they wanted to do a buyback, they do it from abroad.
Okay. The question is, Apple pays both a dividend and does buybacks. And obviously, if you look at their cash balance, it looks like they can afford to do whatever they want, 170 billion. 105 billion of the 170 billion is trapped. You know what I mean by trapped. It's overseas money that they bring in. They've got to pay the tax difference. Right? And so, but they still have 65 billion. That's the advantage of your Apple. It's not even, they don't even need a cash balance. All they have to do is collect 1/4 of iPhone profits and they can pay a $30 billion dividend. You could only, as a company, you just have to pray and hope you have Apple-like problems. These are luxury problems to have. I have too much cash, what do I do with the cash? Money's coming in, I can't stop it coming in, what do I do, right? But if Apple wanted to do a $120 billion dividend or a $120 billion buyback, this applies to both, it cannot use the cash overseas. But it has a way out, right? You have all this cash overseas. Do you think you can borrow money on that basis? Yeah, the bank sees 170 billion. So go ahead and borrow. If you have perverse tax laws, you will have perverse consequences. So the U.S. reaps what it sows. Is that cash can be used for anything but paying dividends and buying back stock to U.S. investors or investing in the U.S. You can do whatever else you want. You can invest in Greenland, Antarctica, Ukraine, anywhere but the U.S. I know that was not the intent of the law, but that's the end game. So they cannot use that cash for dividends or buybacks. They can use only the cash in the U.S. It's not that they cannot, but if they do, they've got to pay that differential tax. Right? Now let's talk about bad reasons for paying dividends. And you hear this all the time from companies that start to pay dividends or increase dividends. This is actually a reason that you hear from investors in companies. And here's what I hear, and this is deep value investors often use this argument. They say dividends are certain, capital gains are not. See where it's going to go next, right? If dividends are certain, I'll value a company that pays dividends more highly than a company that doesn't pay dividends. It has the same investments. The failure in this argument is the following. Remember what happens on the ex-dividend day? You pay a dividend, you lose price, appreciation. It's not dividends today versus capital gains in the future that we're talking about. It's dividends today versus capital gains today. And if you compare apples to apples, there's nothing more certain about dividends than there is about receiving the same capital gain today. So if people are saying, well, we pay dividends because markets will price us more highly, that's neither true in theory nor is it true in practice, but there are lots of companies that fall into that trap. Let's pay big dividends. Investors will think we're safe. This is the bankers' problem with banks, right? They think by paying big dividends, we're going to forget about all that other stuff going on behind the curtain. It doesn't happen. So dividends are not more certain. And I call this the bird in the hand fallacy, which is, I know dividends are the bird in the hand, capital gains are the bird in the bush, et cetera, et cetera, et cetera. And the rest of the argument follows. Question? Who's you? There are no requirements. So companies will offer you a reinvestment option on dividends. It doesn't change your taxes. You'll still have to pay the taxes on the dividends as if you got paid the dividend, and you're not required to. So companies will give you the option at the market price. So it's not there's no special discount you get from it. So even if that reinvestment option exists, it doesn't benefit you. And if you're an individual investor and you invest in, let's say you Schwab online, I know that's my broker, and I buy 1,000 shares of a company. When I buy the shares of the company, there's a little box at the bottom that asks me, do I want to reinvest dividends back into the company or collect in the cash balance? I can check the box, in which case they just reinvest the dividends, which screws up my 1,000 shares, becomes 1,007, 1,015, or collect the cash back. I choose to collect the cash back. But whether I collect my cash back or reinvest it, my tax consequences are exactly the same. So there's nothing you gain by receiving dividends that you could not have done with a stock buyback. Okay? I don't know whether that answered your question, but when you say reinvestment, that's what I'm thinking about, is you as an investor reinvesting back in the company. Okay? So there's nothing you gain by receiving dividends as opposed to capital gains. Okay? Second bad argument. We had a really good year this year, let's go pay dividends. Excess cash, right? The only problem with that is, how do we describe dividends? They're sticky. You have a really good year, you start to pay dividends, and then it happened to be an unusually good year, you're going to be trapped. So if you're an oil company that set dividends based on a $110 oil price and expected it to continue forever, you're in deep trouble. Okay? You're saying, so what? I can always go out and raise capital. I live in a Miller Modigliani world, if only. We know it costs money to raise capital. In fact, it can cost you a lot of money, especially if you're a small company. This is actually your issuance costs, the transactions cost with raising new equity and debt. If you look across the board, the larger the company, the smaller the cost. But even with very large companies, there is a cost. And with small companies, the cost can be large. It's much greater if you issue equity as opposed to debt. So the cost of issuing, which is one reason companies are reluctant to issue new shares once they go public. It's an expensive way to cover payment of dividends. Doesn't mean companies don't do it. Right? Thousands of companies pay dividends and buy back stock and issue shares at the same time. But you can see why that's not a good idea. So don't pay dividends because they're more certain. Don't pay dividends because you had a really good year. Now let's talk about good reasons for paying dividends. The first is what's called the clientele effect. And it sounds fancy, but here's what it means. If your stockholders happen to be stockholders who like dividends, and we'll talk about some subsets of stockholders who do, then you should try to pay more in dividends. Okay? The second is a signaling story. One of the most dangerous things in finance is signaling. We'll see why. Where basically what you do is you use dividends to signal to the market that you're a certain kind of company. That you're a growth company, a great company, you have great cash flows, you have stable earnings, whatever. And the third story is not a noble story, but it does happen in the background. Dividends may be one way in which you can rip off your bondholders. I'd say it was a good way, but essentially it might be a way in which you can transfer wealth from lenders to the company to yourself. So let's take each of these stories. Let's start with a clientele story. And I'm going to start with one of the most puzzling studies when it first came out ever. And it was a company that's still around called Citizens Utility. It's upstate New York, I think, utility. And what made Citizens Utility fairly unique was the fact that it had two classes of shares. That's by itself not unique. There are lots of companies with two classes of shares, but most of those companies, the differences are in voting rights. Here's what made Citizens Utility fairly unusual. Class A shares pay cash dividend. So you guys are going to receive Class A shares. You get a cash dividend every. So it's like regular shares. Class B shares, and you guys are going to get Class B shares, get exactly the same dividend. So if I paid a 2% dividend as my cash dividend, you get a 2% dividend, but you get it as more shares. Now normally, stock dividends are one of the great sleight of hands of all time because really it means nothing. So if I keep giving shares to everybody, it's like I gave shares to nobody. Everybody gets 2% more. But in this case, here's what makes it unique. Your Class B shares can be converted to Class A shares at any time. So the minute I pay you the 2% in Class B shares, you can convert into Class A shares. So in effect, what am I doing? I'm giving you a choice between would you rather get the 2% as cash dividends or the 2% in price appreciation. So in theory, and this was, remember, this study was done in the 70s and the 80s when the tax rate on dividends was much higher than the capital gains. The researchers actually expected to see which class of shares priced more highly. Class B should be priced more highly. It's all capital gains, right? This is one of those studies where you walk in expecting to see one thing and you get a very different result. What they found was consistently Class A shares traded at a premium on Class B shares. For whatever reason in Citizens Utility, investors paid a premium to get a cash dividend instead of a price appreciation. Sounds strange, right? Tax rates are so different. In fact, this study has been replicated with a bunch of Canadian utilities that have exactly the same phenomenon, cash dividend shares. And with every one of these companies, these Canadian utilities, the cash dividend shares traded a premium over the price appreciation shares. Now, if you generalize from this, what do we learn? If you made this a general lesson, you say every company should pay out everything in dividends because it looked like investors. Here's the problem, though. This is true for these companies, and these companies attract a certain kind of investors. What kind of investors? Well, there are actually studies that look across investors and find that if you look at companies that pay big dividends, you tend to attract older and poorer investors on a relative basis. You think, so what? Older and poorer investors might not face the tax issues that younger investors do with dividends and capital gains. They might actually want that cash, the check in the mail every 3 months from the company with the cash dividend. Or there might be pension funds that say we need the cash to cover our liability streams. All I'm saying is if your investor base likes dividends, it might be because they're older, it might be because they're poorer, it might be because of tax-exempt pension funds, and you're paying them dividends, it's a match made in heaven. I can't come to you and say, well, taxes on dividends are higher than capital gains, cut them to zero. If you did, your stockholders would be really mad at you. That's what's called the clientele effect, which is if you pay big dividends, you attract investors who like big dividends. If you pay low dividends, you attract investors who like low dividends. If you pay no dividends, you attract investors who like no dividends. And as long as the demand and supply within each group is okay, all three groups can coexist. You can have companies with high dividends that investors are fine with. And you know when it becomes a problem? Is if you're a company that pays high dividends, can afford to pay high dividends, you've paid high dividends for a long time, you've attracted investors who like high dividends, but then the world changes around you. In what way? Your business becomes more competitive. It requires more reinvestment. You see the quandary you face? You no longer want to pay dividends, but you're trapped by your existing dividend policy. So I'm going to put you in that spot because if you look across companies, you can see this clientele effect kick in. Companies which have, so this actually is a study where people regress, or the researchers regress the dividend yield on companies against different characteristics, and they found, not surprisingly, that riskier companies pay lower dividends, firms with older investors pay higher dividends, wealthier investors pay lower dividends, and if the tax rate on dividends is higher than capital gains, dividend yields tend to go down. So here's what I'm going to do. I'm going to make you the CEO of a phone company, the old phone companies. Remember Pacific Bell, New York Bell, etc. Phone companies were the biggest dividend payers of the last century. Going back to AT&T, right? One of the, paid out huge dividends. And investors would buy these shares for the dividends. So you accumulated investors who like dividends, you pay a big dividend. You're saying, what's the big deal? Your phone company has now become a telecom media technology company. The business has changed. And you discover that you're now in a higher growth, higher reinvestment business. See what the problem is? The old phone companies didn't need to reinvest very much. They were monopolies. The business was stable. Now you're in a new business and you need to reinvest more. But you're trapped by the fact that you pay big dividends. So here are the choices. And you tell me as a CEO which choice sounds most appealing to you. The first is you get up in front of your stockholders who are all who? Older, poorer investors who like dividends. And you very courageously tell them that you plan to cut dividends and reinvest more in these new businesses. Any of you want to go down that road? You can, but you're not going to be CEO right after you finish that speech. You're probably going to be out of the door, right? You can already see why you're trapped. Your investors want high dividends. You need to reinvest. So here's the second choice. You continue to pay the dividends that your investors used to. You hold off on investment in the new market, but then competitors come in, and you as a CEO don't look very good. Here's the third choice. You continue to pay the dividends you used to, make the investments you need to, and issue new shares to cover the difference. Or borrow money to cover the difference. This is exactly what telecom companies did in the late 90s. When the business shifted, many of these phone companies were spun off from AT&T. They had the investors who liked big dividends. They continued to pay the dividends, but then they tried to make up the difference by either issuing new shares or worse, borrowing money. And many of them ended up as over-levered messes because nobody wanted to face up to the fact that the world was shifting. This is, when we talk about disruption in businesses, this is one of the things that needs to be dealt with. If you're in a business being disrupted, all the old rules have to be thrown out of the window, including the fact that you historically paid big dividends. That might no longer work if your business is no longer a stable business. So take a look around at businesses you're familiar with to see which ones are going to go through this phase next, because many of them are going to face this dividend problem. Any questions on the clientele effect? Yeah.
Essentially, if you went with A, would you then shed those investors as they move to?
The question is, you're right. We'll talk about this. It is true there will be a transition period. The only problem is you'll probably lose your job before the transition gets over, because it takes 6 months, a year and a half, 2 years for it to kind of work out. We'll talk about this because there are, at least with a couple of companies later on, which have tried this, change dividends, and it's very messy. And the problem is, for you as a CEO, the end result might be the healthy result you wanted, but you won't be the CEO for that healthier, better company, which puts you in a bad... There's another choice. In fact, Verizon tried this when wireless took off. You know what they did? They spun it off as a separate company with no dividends. And essentially, they let people decide in the company, they let their stockholders decide whether they were going to take the exchange or not, which meant those investors who didn't care about dividends were much more willing to exchange for the... So that's another intermediate choice. We can try to have your cake and eat it too, is to try to create that spun off entity with its own dividend policy. AT&T did this with their Bell Labs. Bell Labs, if you remember, was the ultimate research place where people just could do research on whatever they wanted. And as long as AT&T was a monopoly, Bell Labs was just a cost center. You just wrote the checks out. You want a Nobel Prize winner working on something? No, just give them $1 million. And then AT&T became a public company in a competitive marketplace. They decided to, because Bell Labs had all these patents, it was really a technology company, they decided to spin it off, and they called it, you know what the original name for? Well, they called it Lucent. But here's the fatal mistake they made. They essentially gave every AT&T shareholder a proportionate share in Lucent. What is the problem with that? Well, all the AT&T shareholders were big dividend, used to receiving dividends. They now held Lucent. You could tell them till you're blue in the face. This is a technology company, but they don't care. They just want the dividend. So Lucent actually continued to pay dividends as if it were a phone company, and then borrowed money to make up for it, and then did stupid acquisitions to cover the borrowing up. And the whole thing, of course, blew up ultimately. So there is no Lucent anymore. It became part of Alcatel, which is now going to become part of somebody else. But it's a cautionary note. When things change, you have to kind of arrange or set up something where you get a different investor base for that new company you're creating. Okay. Any other questions on the clientele effect? Yeah.
If as a company we've never paid dividends before, is that like a rule of thumb to analyze the stockholder base?
If you've never paid dividends before, is there a rule of thumb? I'd say the simplest rule of thumb is that phone on your desk and the top 17 investors you have on your... it's something that's always surprised me at companies, how reluctant they are. They'll talk to analysts till they're blue in the face. Analysts own no shares in your company. What difference does it make what they think about what you do? They have this list of, here are my top 20 investors. Let's call them in and talk about what we're going to do. So if you're the CEO of a company, you don't need to look at hold feathers up to theirs or what way the wind blowing. You can actually go out and ask investors what they think about this. And usually when you initiate dividend, it's usually so small when you start off that there's a transition phase that comes in from the fact that as you step up the dividend, your investor base might change. Okay? And with buybacks, you've created a new tool to actually allow yourself to return cash without having to deal with this clientele effect. Any other questions on the clientele effect? Here's the second. Dividends are a signal. What do I mean by that? Well, let's assume you're a company with great projects. How do you convince the market that you have great projects? You can call a press conference and say, we have great projects. But so can anybody else, right? So one of the big struggles you face in markets is separating yourself from the pack. Doing something that in companies that are not as high quality as you will be unable to match up. That is the essence of a good signal. A good signal means that you do something and companies that are not as of high quality are unable to match that up. We'll come back and ask, are dividends a good signal on that basis? And here's how you can test to see whether dividends are a signal. Remember I talked about the dividend declaration day when a company announces dividends are going up or dividends are cut. There are studies that focus on what happens when dividend changes are announced. Not that much of a surprise. If you look at companies that announce dividend cuts, the stock price tends to drop around the dividend cut by about 4.6%. So that's the announcement day. That's the day of that the dividend was cut. When you look at dividend increases, roughly speaking, on the day the dividend increase is announced, the stock price increases by roughly 1%. Let me pause that. When a dividend is cut, the stock price drops by 4.6%. When the dividend is increased, it increases by only 1%. Why do you think there's such a big disparity in the effects? Why is a dividend cut so much worse news than a dividend increase is good news? That might you can't rule that out. That could be one part of it, but they could overreact to good news too, right? I mean, their overreaction is a problem overall with both good and bad news, but that could be.
Because companies will cut dividends and that is the last resort, and so it's really bad news when they start cutting the dividend.
Remember when I showed you that graph of dividend changes by company going back to 1988? When you get a chance, go back and look at that graph. Of course, 60% of companies don't change dividends every year. So I used it as a basis for showing dividends was sticky. But then if you looked at companies that change dividends, what do we see? About 5 times more companies increase dividends than decrease dividends, right? That's actually very roughly proportional to the effect you're seeing. A dividend increase is much more common than a dividend decrease. And because it's more common, it's less good news to see a company increase dividends than it's bad news to see a company cut dividends. Companies don't cut dividends until they absolutely have to. So when they cut dividends, say, oh my God, the bottom must have fallen out. Otherwise, why else would they have cut dividends? So this seems pretty clear cut, right? Dividends are signals.
How does this tie into the good projects, bad projects?
That's a good question.
The good projects, you expect them.
In fact, why don't you help me out here? Can you tell me a story where increase in dividends is bad news? I've told you the story about increase in dividends being good news. People look at it and say, that must mean you have better earnings, that's why increased dividends. Tell me the bad news story. Company increases dividends. It's not just that. By increasing dividends, what are they also sending you as a signal? Remember, you don't get to see what projects a company has, right? You? Go ahead. There's no what? In other words, a company is sending the signal, we don't have good projects left. So I could very easily, and this is exactly the problem with signaling stories, is you can spin them around. I didn't see anybody with a suit here today. Now, usually when you see a person in a suit, what are they dressed up for? Not corporate finance, clearly. I don't dress up. Why should you dress up? It's because you have an interview. Why do you wear a suit to an interview, especially in the middle of summer? It's not to feel comfortable. It's to signal to the interviewer that you really, really want this job. Say, look, this is how much I want this job. I'm wearing this shirt and a tie and I'm sweating like a pig. But I'm willing to dress up like this just so that you give me a job. So you're saying the suit must be, but the problem, so when I first started teaching, people said you have to wear a suit. Because you've got to signal to students that you're serious about this stuff. I said, what if it's a 15-minute session and that's what the entire class is, maybe the signal will work. 26 sessions, whether I'm in a suit or in a shirt or in my shorts or in swim trunks, by 26 sessions the truth is going to come out. And also, what kind of signal am I going to send? I can't afford a Barney suit. I'm going to buy a $400 Today's Man or whatever, a Men's Warehouse suit. I'll be signaling that I can't afford to buy the suits you can. I don't want to send that signal. So signaling can cut all kinds of ways depending on how you read the signal. So I'm very, very cynical about the signaling story, especially with dividends, because you can find evidence that dividends can be bad signals as well. And here's what. This is a study that actually looked at earnings growth before and after. Remember we talked about companies that start paying dividends? Earnings growth before and after dividends are started. So there's the earnings growth leading up to the dividend. So 1 quarter before the dividend is increased, there's high earnings growth. 1 quarter after. So around the dividend initiation, earnings growth is really high. But if you look at what happens after, you see that decline in earnings growth. So you could make as strong a story about dividends being a negative signal as they are a positive signal. One final point about signaling. Is it bad to signal that you don't have projects? Somebody said no. Why not?
Because you're responsible. You're telling the market that you'll wait for it.
In other words, if you really don't have projects, you should be signaling you don't have projects. That's why it drives me crazy when people say, well, GM buying back stocks is signaling that it doesn't have good projects. Really? You need to watch some buyback stocks to get this signal? You haven't been looking at their revenues and earnings for the last 5 years? I mean, claiming that GM is using buybacks to signal that it has no projects, like claiming that a blind person is using that stick in front of him to signal that he's blind. Yes, he is. Because he wants you to know he's blind and say, get out of my way. Signaling the truth is never wrong. If you really have great projects and you pay a dividend, you're doing a disservice, right? Because then you're signaling something that's not the truth. Your problem is not a signaling problem. It's a messaging problem. But if you really don't have good projects, there's nothing wrong. And for most companies, by the time they buy back stock or pay dividends, they don't need to signal that they don't have projects. Apple didn't send me a signal they didn't have projects. All I had to do was see how much their cash balance accumulated each quarter to know that the number of projects they had was vastly lower than what they were getting in as cash flows. So signaling stories are desperation stories in my view. But one of the interesting things that's happening with dividends is even if you buy into that signaling story, they're becoming less informative over time. And what I mean by that is you look at the price reaction to dividend changes, they're smaller now than they used to be 20 years ago or 40 years ago. What do you think that is? Why do dividends convey less information now than did 50 years ago? Because 50 years ago, if you bought stock in a company, you'd had no access to equity research reports. How do you get information? You probably opened up the paper every day and you saw a price on your company. That's the extent of information. If you were lucky, you might get an annual report. No SEC filings. No Yahoo Finance or Google Finance look things up. As information gets richer, it gets sillier and sillier to talk about dividends being the way you signal to the market, especially when a company the size of Apple or GM. If you're paying dividends, please don't do it because you want to signal to the market. There are far cheaper and more efficient ways for you to signal than using dividends as your signaling mechanism. So that's the second story for dividends. You're using dividends as a signal. It works if you're a small company, nobody notices you. Maybe you can sell me that argument, but not if you're a larger company with a higher profile, with a dozen equity research analysts who are tracking you. There must be a more efficient way for you to get the information out. Which brings me to my final story for why companies might pay dividends. By paying dividends, you might make your bondholders worse off. In fact, yesterday I was reading an article about how banks and bondholders are very, very disturbed by the buyback trend. And you can see why, right? When you have a buyback, cash leaves the company. And if you've lent to a company, buybacks automatically make you riskier. If you really are worried about this, you know what you need to start doing? You can't wait till it happens and then complain. That's like being Nabisco. You got to start to build it into your covenants and your bondholder agreements where you say, look, if you do more than X billion dollars in buyback, my interest rate goes up. Negotiate it up front. Don't bitch and moan about it. But you can see that when you have dividends increasing, decreasing. Remember that graph I showed you and what happens to stock prices? If you look at what happens to bond prices, you get the exact opposite effect. A dividend increase leads to a drop in bond prices. A dividend decrease leads to an increase in bond prices. So 3 good reasons for paying dividends. You have a clientele, an investor base that likes dividends, or you're a small company that's using dividends as a way of sending news to the market, or you're people who've lent you money who've essentially given you a buffer. They've already built in the assumption you're going to pay dividends. You have to pay the dividends then because if you don't, you're going to transfer wealth to them. Any questions on any of those 3? So let's look at what companies actually look at when they pay dividends. So this is actually the result of a survey that was done of CFOs who were asked, hey, what do you look at when you decide how much to pay in dividends? So don't take this as the right answer. This is what companies claim at the time that they pay dividends. So they were asked, is a firm's dividend payout ratio, does it affect the price of the stock? 61% said yes, it does affect the price of the stock. They believe payout ratios matter. Dividend payments provide a signal. 52% agreed, 7% disagreed. It's amazing. Look at the percentage which have no opinion. They either have no opinion because they've thought through both sides and they can't make up their mind, or they have no opinion because they just have out to lunch. I'm not sure what that middle column should be read as. No? Markets use dividend announcements as information for assessing firm value, 43% yes. Investors are indifferent between dividends and capital gains, only 6% agreed with that. So again, this is not an indication of what's right or wrong. This is what CFOs go in as conceptions or misconceptions about dividend policy, and it drives how much they pay in dividends. So that's the trade-off in dividends. I'm going to start the process on looking at how much companies should pay in dividends. Okay? Or put differently, how much cash is too much cash? So if I showed you Apple and said $150 billion, is that too big a cash balance? I want to give you the tools to be able to make that assessment. So what we're focusing on now is really how much should you return in cash. So we're going to broaden the discussion beyond dividends to buybacks and how much cash should be returned. To set this process up, I'm going to give you 2 different approaches that we're going to use, and they're going to kind of parallel what we did with capital structure. The first is what I call the cash trust nexus. I'm going to argue that more than any other aspect of corporate finance, dividend policy rests on trust. The trust that investors have in managers. Let me cut to the chase. If I am an investor and I don't trust you as a manager, guess how much I want you to pay in dividends? Everything you can. If I trust you as a manager, then I'm going to let you hold on to my cash. It's as simple as that. You're saying, how the heck am I going to gauge the trust? What do we base trust on? Past behavior. Past experience. So if you're a manager who's done good things for me, who's not done stupid acquisitions, who's delivered great results, I'm more likely to trust you. if you've lied like a rug, taken stupid projects, big acquisitions, I'm not going to trust you. So the cash trust nexus is about bringing in tools to make that judgment. The second is what we did with capital structure. How do most companies decide how much to borrow? They look at what other companies borrow. How do companies decide how much to pay in dividends? They look at what everybody else does. I'm actually going to put up a blog post on CEO pay today. I mean, of course, there's this whole debate about are CEOs overpaid. I think they are. But they're being overpaid, I think, because we're in this very strange game where, you know how boards decide how much to pay a CEO? They hire a pay consultant who shows them this peer group, these 15 other companies in their sector, and what they pay their CEOs. Then guess what you pay? You pay what they pay. More examples of Me Tooism in corporate finance. So the second approach, you just look at what everybody else is paying in dividends and you try to stay as close as you can to what everybody else does. So let's take that first approach, because to me that is the hefty approach, the way in which you can make a judgment. Okay? And I'd like you to try this on your company when you get to this stage. There are 3 questions I'm going to ask about every company I want to analyze. The first is, how much has this company returned to its stockholders over time in dividends and stock buybacks? I'm now going to expand the definition. Second, how much could this company have returned to its stockholders over time? You're saying, how the heck am I going to answer that question? If you ran a business, how much can you take out of the business? That's essentially how much can you pay yourself as dividends? Whatever's left in the till after you've met every conceivable need, right? So if you're growing and you have to reinvest, you can't take that out. So we're going to come up with a way of measuring how much companies could have returned, and we're going to compare it to what they actually did return. And I'm going to show you a graph that 70% of companies globally return less in cash than they can. That's not meant to be a value judgment, that's a bad thing, but they accumulate cash. And then the question becomes, do you as stockholders trust the managers of these companies with your cash? And to answer that, I'm going to see how well did you pick investments in the past and how well is your stock done. The advantage of doing dividend policy at this stage in corporate finance is we have answers to both questions, right? When we looked at the return on capital and cost of capital for a company, we made judgments on did this company pick good projects. When we looked at the Jensen's Alpha, we looked at how well or badly your stock has done. You have the mechanics to make this judgment now on numbers that you have in front of you. So let's start with that first question. How much has my company returned to its stockholders? So again, I took my 5 companies and I took dividends and buybacks on each of them. Okay? So if I look at Disney, between 2008 and 2012, they've paid $4.5 billion in dividends collectively over the 5 years. But that's just the tip of the iceberg, because they also bought back $15.4 billion worth of stock over the same period. Another example of how U.S. companies have increasingly shifted from dividends to buybacks. So over this 5-year period, Disney has returned more than almost 80% of its cash has come in the form of buybacks and only 20% in dividends. Vale actually has started paying, has had buybacks, $5.8 billion. And that's what I meant about this starting to spread outside the U.S. is increasingly you're seeing companies outside the U.S. starting to use buybacks. But the bulk of their cash is in the form of dividends. Tata Motors is all dividends, 51.4 billion rupees. There's a tiny amount of buyback. I don't even know what that buyback is. It was so small that I'm not sure it's a general buyback. Maybe it's a selective buyback, something that they did. Baidu was a very easy case. No dividends, no buybacks. If you're one of these companies, don't give up at this stage. Say, there's no dividends, therefore I don't have to do this section. You still have to do this section. Because you know the question you need to address? Is should they return no cash? It's still a dividend policy. Paying no dividends is a dividend policy. Returning no cash is a dividend policy. And finally, for Deutsche, there's the collective dividend, 4.4 billion euros, no buybacks. So that's what they've returned, and that's the first place to start with your company. What has my company returned? Now let's look at what these companies could have returned. About 25 years ago, I juggled these different measures of cash flows to try to come up with a measure of what cash would be left over for equity investors after every need was met. And the way I answered this question, I thought about running a private business, and I thought about what cash would be left in the till at the end of the year. So here's how I'd start. I'd start with net income. Remember, I'm an equity investor, so I focus on my measure of income, which is equity, which is net income. Not operating income, not after-tax operating income, but net income. I add back depreciation, amortization. By this point in time, that should be second nature, but why am I doing that? Because it's a non-cash expense, I'm adding it back. And then the fun begins, or actually the pain begins. So this is the collective cash flow, and I start writing checks out to everybody that I have to pay. First, if I have preferred stockholders in my company, I have to pay them preferred dividends. So that's a cash outflow. Capital expenditures, land, building, equipment, cash outflow. Working capital needs, inventory went up, now the cash outflow. So think of writing out the checks. So check 1, check 2, check 3. Okay? That's my free cash flow to equity before I make any new debt issues or make debt payments. If I have debt payments, that's a cash outflow. But any new debt that I take in, and this is a little intuitively tough to get around, but new borrow money, cash comes into the company, right? The bank sends you a check for no. That bottom line is called the free cash flow to equity. It is one of the most misused and misunderstood terms in finance. So I want you to be clear about what you're measuring. It's the cash left over after taxes, after reinvestment needs, and after debt payments. So let's make this the fulcrum for looking at dividend policy. First, if you have a company with positive net income, can its free cash flow to equity be negative? Yes, and what has to happen? Big capex, big working capital needs, or big debt payments. And if your free cash flow to equity is negative, how much should you return to your stockholders? Nothing. So dividend policy 101 with Baidu, that's what you're looking for. Maybe the free cash flow to equity is negative every year, in which case it makes entire sense for them not to pay dividends. So if you have a non-dividend paying, non-buyback doing company, that's what you're looking at. Are the free cash flows to equity negative? If the free cash flow to equity is positive, that I call a potential dividend. I'm not going to force you to pay it out. Legally, I can't require you to pay it out, but that is the amount you can pay out to your stockholders as dividends, buyback, whatever you choose to do, or you can hold it back in the company, and if you do, it increases your cash balance. So that's a computation of free. You can see it's messy. Lots of items go in. There's a shortcut you can use, but to use the shortcut, you have to make an assumption. If you're willing to assume that a constant proportion of your reinvestment, that the capex minus depreciation and working capital, a constant proportion that comes from debt. So as an example, if you say, from this day on, 25% of whatever I need to reinvest is going to come from debt, here's a shortcut that you can use to get to free cash flow to equity. You can start with the net income, subtract out the equity portion, the 75% of what's called net capex. You're saying, why are you netting depreciation against capex? Depreciation is a cash inflow, capex is a cash outflow. Net capex measures what I need to come up with. And if 75% has come from equity, I'm very equity focused in this computation. All I care about is, what do I need to pay for? 75% of my net capex, 75% of my working capital, end up with free cash flow to equity. This works only if you're willing to assume that the debt ratio stays stable. It's a much more specific version. The previous page will always work. This one will work only if you have a stable debt ratio. That's what I'm going to use to address the question of how much could my company have paid out in dividends. So let me try this for Disney. All of these numbers, net capex, if you think about the items I need net income, capex, depreciation, working capital, debt repayments, debt issuances, dividends, buybacks. Guess which financial statement you're going to be using for this part of the analysis? Statement of cash flows. Everything should be there. The only thing is the statement of cash flows, the sign is put in front of it. They try to be helpful. So with the capex, there'll be a minus in front. So make sure you don't reverse a minus of a minus and make it plus. So that's all you need. And so I took the statement of cash flows, and each year I computed the free cash flow to equity before debt payments. There's 17.3 billion. After debt payments, it was 27 billion. So how come it's going up? Because during this 5-year period, Disney borrowed more money than it paid out. The reason I separate the two is I want to be cautious that I'm not paying our dividends just with borrowed money. So I want to compute both free cash flows equity, 17.3 and 27 billion. What they actually returned over this 5-year period was 19.9 billion. They returned more than the free cash flow to equity from operations. But they didn't go all the way to 27 billion. So some of their buybacks are coming from increasing debt ratio. Is that okay with Disney though? When we did the optimal debt ratio for Disney, we discovered they were at 11.6% debt. And that's again the advantage of drawing on so when you get to capital structure, dividend policy, don't forget what you did in capital structure. Because if your company is under levered and it's using debt to pay dividends, it's not a bad thing. That's what you want them to do, and that's what Disney seems to be doing. So that's what we're going to do with each of these companies, is we're going to compute what they could have paid out. We're going to look at what they actually did pay out. And then we're going to ask the completion question. With this company, do I trust the managers of this company with my cash? And that's where you're going to differentiate across companies as a stockholder. So let's pause there. We'll start, after the quiz, we will continue with this section. Okay, so if you get a chance, bring your statement of cash flows with you to class on Wednesday, because then you can kind of look at it while we go through this process. Yeah.
So, first of all, Bloomberg, so this is something I looked at a long time ago, Cap IQ, and then we examined recently Bloomberg, having a completely different set of investors, like very little overlap in the same company.
Does it change the type of investors? Doesn't have to, the names of the investors don't matter, right? If it's institutional, it's institutional. So if it's a different set of institutions, you're okay. If an individual pops up in one and not in the other, then you might have some issues. But if it's State Street in one and BlackRock in the other, one.
Invesco is the number one, Bloomberg, they don't even show the Cap IQ.
It's just different timing for the SEC filings that they use probably.
So then the other thing I was curious about, I'm looking at they make ski news, jet skis and stuff like that. They have a tiny little part of their business that does like airplane engines.
How tiny?
I mean, it's like probably 5% revenue, something like that.
Probably not even worth
Is
breaking.
leisure products too broad of a category for the bottom up beta?
No, it's fine.
It's okay.
Yep.
I was going over your LBO article for Dell a couple of years ago. Going over that for another class, and well, you addressed that you thought that Michael Dell was getting a deal.
Yeah. The blog post you mean on
Yeah,
that?
blog post, yeah. The thing is, when he did that, the transaction hadn't closed, and the thing I was trying to look at is why the board changed the voting, the way the votes were,
because it's Michael Dell's board. They wanted him to win.
okay, so it's just
Simple
the
as
board
that.
wasn't independent even if they had the independent.
Of course.
That's what
They had to, the problem they faced was they were in the limelight so much that they could not be obviously biased because then they'd get sued. So they were providing themselves legal cover while they were making, so they had to provide the legal cover of we're being independent, look, we're bending over backwards. That's why I think they got three different, they had to, and that was basically the legal cover, but the bottom line was once they got all of that stuff, they wanted Dell to win.
Yeah, that's what it seems.
But the problem is if the price from the outsiders had been much higher, let's say 17 or 18, they wouldn't have been able to, even though they were biased, their legal jeopardy would have been too large if they'd accepted the lower offer. But it was close enough that they were able to get away with saying, you know, this is a better offer for us. Okay. Yes.
Some emerging market companies, just different. It's all a shareholder loans.
Yeah, basically what it is
They're expensing dividends.
it's exactly right, and it's a tax. It also while getting a tax benefit. Yeah. And it's a very, very big loophole in some emerging markets. Family businesses, you're allowed to give yourself. When I value these companies, I treat those shareholder loans as equity.
You treat them as equity.
Yeah. I treat them as equity because you're not going first. They don't have the tax advantage. I will leave in the cash flows, but I treat them as equity for things like levered because you're not going to push a company into default.
Right, because
It's your own loan, right? So it's in a sense, it's a tax dodge.
But they are fixed.
They're fixed, but the fixed pay, the teeth behind the fixed payments is if you don't make those fixed payments, what happens to you? They're fixed payments like dividends are
They're
fixed
like a
payments.
preferred
Right?
dividend.
It's like a preferred dividend, exactly. You're not, if they don't make them, you're not pushing them into bankruptcy.
Right.
In fact, what's kind of dicey here is they can use the legal process
Right.
to actually make the rest of the equity investors
To subordinate everyone else.
Essentially, they can screw over the. I think it should not be allowed, to be quite honest, because it's a recipe for all kinds of internal game playing where the founder, promoter, family that runs the company essentially, A, takes advantage of the tax law, B, takes advantage of the rest of the equity investors, because it can use this process to its advantage. It can say, well, we had a debt payment problem, so we're required to turn over 50% of our equity rights to the lender, which happens to be
Right.
the founder. So,
But I mean, like, and the other thing which I thought was interesting was some of them use US dollar loans, so they're also making.
and also in some cases, if it's a family group company, you have subsidized loans, you have
Right.
one company gaining, the other company losing, you have interest-free loans.
So you
know.
include that? Do you include that? Do you include the interest payment in your payout ratio?
Yeah, you'd include, if you treat it as equity, you have to treat the interest payment as part of the payout ratio. It's very messy because you get the tax, it's a tax advantage dividend with a tax advantage, with the regular dividend put into it.
And also public company in this one.
And they're big companies, and some of these companies are really big companies too. It's not as if these are tiny companies that are under the radar. They're
Right,
big family
Isn't that
group
why
companies.
Tata's payout
Ta-
ratio is so high?
No, Tata doesn't have intra-family loans. I mean, that's it's perhaps of all the family groups in India, it's perhaps the most legitimate and above board family group. But there are other companies like the Satyam Computers, which was in fact that court case is working its way through because they had personal loans, had all kinds of stuff. That the company loaning the owner money at 0% interest rate. Strange things going on. So all kinds of stuff.
Run the return on investment analysis through your spreadsheet. I'm doing Hershey's in the chocolate company, and that's something around between 60 to 80 if I play with the cash. Doesn't yeah, so it's I won't.
I mean, you get that number, whether you use that number as your measure of what the profits are still
Well, I do an average just to see that it's not an average.
or if you know what the buybacks are, you can go and have the buybacks back and see what that does to your return on invested capital. Because maybe adding the buybacks to the denominator
Will change.
will change it.
So not to put you have the cash, the percentage of cash, and something else that you said it's a ratio that you can play with. And the default was not to change. Right? So just do it like this. If I don't. Thanks.